You know, it's funny how we think about the money we spend, right? You swipe a credit card for a coffee, you see $5 leave your checking account, and that's basically it.
Right, it's binary.
Exactly. The money was there, and now it's gone. It feels, I don't know, incredibly precise, almost comforting because you can track every single penny leaving your pocket.
It feels like basic physics, you know?
Yeah.
Like every action has this immediate, equal, and opposite reaction on your bank balance.
Yeah, but then you look at your overall financial picture, or, worse, you look at the financials of a growing business, and suddenly the math completely stops acting like simple physics. It gets super murky.
Oh, absolutely.
You realize that money is just bleeding out of the system in ways you can't easily see, and you're spending cash on things you aren't even using.
It is the absolute definition of diagnostic muddy waters. I mean, most people, and honestly a lot of seasoned business managers too, fundamentally misunderstand how costs actually behave in the wild.
Which is exactly why we are here today. So welcome to this custom-tailored deep dive. Our mission today is to completely demystify this whole concept of cost behavior and really transform how you view your spending, how you view scaling, and how you view strategy.
Whether you're running a massive manufacturing empire or just, trying to budget your own life.
Right. And to do this, we've pulled from a pretty wild stack of materials. We've got academic textbooks on managerial accounting, specifically ACC 406 deep dive financial blogs from Wisson Sage Expense Management, study guides from Past Paper Hero, economic breakdowns from the Corporate Finance Institute, or CFI, and even a Wikipedia breakdown on car costs.
There's a lot to get through.
It is. And you're here to help us connect the dots between all this dry accounting math and like real world business survival. So, okay, let's unpack this. Where do we even begin to categorize these invisible costs?
Well, what's really fascinating here is that the best place to start isn't actually with corporate finance at all. Yeah, it's in your driveway. If we want to really anchor the concept of fixed versus variable costs, we just have to look at owning a car. We drastically underestimate what it's doing to our wallets, even though it's like a completely familiar baseline for most of us.
Yeah, the numbers from the American Automobile Association are actually staggering when you aggregate them. They note that the average driver spends about $8,700 a year.
Wow.
Yeah, which is roughly $725 a month just to keep a standard sedan running. And when you break that down by usage, the average U.S. cost is 58 cents per mile.
Right. And we all know the basics there. You've got variable costs like fuel, tolls, and maintenance like tires, which happen when you actually drive. And then the fixed costs like your insurance, taxes, and loan payments, which happen whether you drive or not. And this is key, the fuel and the tires aren't the real problem here.
So what is?
The hidden giant in the room is depreciation. The data actually shows that depreciation eats up 15 to 20% of a car's value every single year.
That is wild.
And sometimes, depending on market conditions, a vehicle can lose up to 30% of its value in year one alone. Depreciation makes up about half the total cost of running a car, and it just happens silently.
So it's like, okay, a car sitting in a garage is basically a leaky bucket. The water, which in this case is the depreciation and the insurance, is just draining out constantly whether you turn the key in the ignition or not.
Exactly. The bucket leaks no matter what you do.
But wait, if I spent $30,000 buying a car and it's just bleeding value in the garage, is that money just gone then? Like, is buying the car a sunk cost?
See, that distinction right there is where so many strategic errors happen. A financial breakdown from Sage Expense Management gives us a really vital framework for this. A sunk cost is money that is gone forever and can never be recovered.
Like what, for example?
Think of a company paying for market research, right?
Yeah.
Or pouring millions into a huge advertising campaign.
Right.
Once you spend that cash, you cannot sell the research back to the surveyor.
Right. You can't return an ad campaign to the billboard company and ask for a refund.
Exactly. You are permanently separated from that capital. But a HAR, or if we look at a business like a massive computer server rack, that is a fixed cost. But it is not a sunk cost because it holds residual value.
Oh, I see. Because you can resell the car.
Right. You can liquidate the server. Understanding that difference gives a management team a lot more strategic flexibility than they might realize. They aren't trapped. They hold an asset that can be converted back into capital, albeit at a depreciated rate.
Okay, so taking this leaky bucket concept, this idea of costs that just drain away no matter what, how does that translate when we scale up to a whole company?
Well, if we connect this to the bigger picture, the leaky bucket concept is what literally dictates a company's entire lifespan. In corporate finance, This is called the burn floor.
The burn floor. I like that term.
Yeah, Sage talks about this. It's the absolute minimum cash a company must spend each month just to exist before they make a single dollar of revenue.
So we were talking about like employee-based salaries, commercial office leases, enterprise software subscriptions like your ERP.
Exactly, all of that. And that burn floor defines your cash runway. If your burn floor is $50,000 a month and you have $200,000 in the bank, you have exactly 4 months to figure out your revenue before the doors close.
Because that fixed cost floor doesn't care if you land 10 clients or 0 clients.
It doesn't care at all. It's ruthless.
But modern infrastructure has shifted heavily toward variable costs to combat this, right? Like the sources bring up cloud computing, specifically AWS or Azure.
Oh, absolutely.
If I build a software startup on AWS, my server bill mirrors my actual usage. If a video goes viral and traffic spikes, my cost goes up. If traffic drops to 0 on a Sunday, my cost scales down instantly.
Right. There's no heavy depreciating physical server sitting in a closet draining value.
Exactly. So that flexibility has to be the dream scenario for cash flow management. You only pay when there is activity.
It is the dream. But operational reality is rarely that clean. You inevitably run into something called stepped costs, which fundamentally break those smooth scaling models we all like to draw on whiteboards.
Yeah, the step costs concept is crucial because it means costs don't always scale smoothly. A study guide from Past Paper Hero actually maps this out with a really good call center scenario.
Right. The team leader example.
Yeah. Let's say a team leader makes $2,000 a month, and they can comfortably manage up to 10 operators. For operators 1 through 10, your fixed management cost is just flat at $2,000.
So the line on your cost graph is perfectly horizontal for a while.
Right. But the exact moment you hire that 11th operator, you hit a step. You absolutely must hire a second team leader. So your management cost instantly doubles, going straight from $2,000 to $4,000 a month just for adding one single employee.
Yep, that's the step.
But let me push back on how this plays out in the real world. Like if I'm a manager staring at my budget and I see that step approaching, wouldn't I just squeeze my existing 10 employees? I mean, I would just demand overtime to handle the volume so I can avoid that sudden $2,000 jump.
Well, you've just identified the classic operational dilemma. Managers do that all the time. They use overtime or they bring in temporary contractors to stretch that tier.
It makes sense on paper.
It does, but if you stretch it too far, you get burnout.
Yeah.
You get high error rates and staff turnover, which honestly often costs significantly more to fix than simply hiring the second manager in the first place.
So it's a complete tightrope walk. You have to know exactly where the steps are hidden in your growth plan.
Exactly.
Because if you blindly hire the 11th person without predicting the step, you trigger a sudden cash flow crisis, since that new $2,000 manager salary isn't covered by just one new operator's output. It takes, what, 3 or 4 new operators for that second manager to actually pay for themselves.
Right. And that operational friction brings us to an even messier reality. Because if business costs were just strictly fixed, variable, or stepped, financial forecasting would be relatively straightforward.
But it's not.
No. The real world is messy. Many costs are completely intertwined. So we have to figure out how to untangle them to make smart decisions.
Right. We're talking about semi-variable or mixed costs here. Think about a commercial utility bill. You might have a fixed monthly standing charge of, say, $600 just to be connected to the grid, plus a variable charge of 8 cents per kilowatt hour actually used. It's a hybrid.
So if you are trying to project next year's budget, you can't just look at the total bill and guess. You have to mathematically isolate the fixed baseline from the variable usage rate.
And to do that, managerial accounting uses a mathematical shorthand called the high-low method.
Right, the high-low method.
Yeah, instead of looking at the whole messy year of data, the high-low method acts like a sniper.
Yeah.
You just isolate your absolute busiest month and your absolute quietest month. The ACC 406 textbook uses a fictional restaurant called Bobby's Burgers to demonstrate this.
Oh yeah, Bobby's Burgers.
Right. They want to figure out the fixed and variable portions of their labor cost over a 6-month period.
So Bobby's looks at March, their peak month, and February, their deadest month. They take the difference in total cash spent between those two extremes, and they divide it by the difference in total labor hours.
Let's give the actual numbers from the textbook. Bobby's March high point is 710 hours with a total cost of $9,010. The February low point is 210 hours with a total cost of $5,110.
Okay, so you calculate the variable rate by subtracting the low cost from the high cost. So
Yeah.
9,010 minus 5,110, and dividing that by the high hours minus the low hours.
Which is 7 and 10 minus 210. So you get a rate of $7.80 per hour.
Exactly. By looking at the cost difference between just those two extreme points, you statistically extract the exact hourly rate of the variable costs. And once you know that variable hourly rate, you can easily calculate what the fixed baseline must be.
Right, you just take the total high cost of $9,010 and subtract the variable portion, which is 7.80 times 710 hours. And that leaves you with a fixed cost of $3,472. But wait, let me challenge the methodology here.
Go for it.
What if the month with the highest cost isn't actually the month with the highest hours? Like maybe in April they had fewer hours but paid out a massive holiday bonus, making it the most expensive month on paper. Which one do I pick for the formula? The highest money or the highest hours?
Okay, this raises an incredibly important question, and it's where forecasters make a very common, very costly mistake.
Oh.
The rule from the textbook is that you always pick your data points based on the highest and lowest activity level, the hours, never the cost.
Of the cost.
Right, because cost is the dependent variable. It reacts to the activity.
Yeah.
If you pick the highest cost month when the hours were actually low, your entire formula will invert and your budget will be completely disconnected from reality.
So the hours drive the bus, you follow the activity, not the cash output.
Always follow the activity. Though I should note, the high-low method is great for a quick estimate, but it only uses 2 data points.
Right, which seems a bit risky.
It is. In the real world, modern companies don't rely on just 2 months. They use statistical software to run the method of least squares, which draws an Excel regression line through every single month of data. Or they use scatter graphs to visually check the correlation.
But the underlying goal remains identical, right? Isolate the fixed from the variable so you can predict the future.
Exactly.
Okay, so now that we know how to calculate our fixed and variable costs, the real game is weaponizing them against your competitors. If you can manipulate that ratio, you unlock economies of scale.
And this is the holy grail of corporate strategy, according to the Corporate Finance Institute. Economies of scale occur because of the inverse relationship between your per-unit fixed cost and the quantity you produce.
Meaning producing more spreads the fixed cost thinner.
Precisely. Because your fixed costs stay the same, every additional unit you produce spreads the fixed cost a little bit thinner across your entire output.
Here's where it gets really interesting. Think of it like buying a $10 million robotic arm for your factory floor. Your fixed costs just skyrocketed, which seems terrifying.
It is terrifying for cash flow.
Yeah, but because the robot is so fast and efficient, every single widget you make now costs a penny in variable costs instead of $1. You produce 1 million widgets, and suddenly that massive fixed investment only costs a few cents per widget.
Right, and you can drastically undercut your competitors on price, and they physically cannot match you without buying their own $10 million robot.
That is the textbook definition of internal economies of scale. The CFI source points to the oil industry's adoption of fracking technology as a prime historical example of this.
Fracking is a perfect example. It required massive, expensive capital investment that only giant firms could afford up front. But once it was operational, it plummeted the per-barrel variable extraction cost, fundamentally changing the oil industry's cost curve permanently.
And there are also external economies of scale, right, which affect a whole industry regardless of internal tech.
Right. For example, if a government offers a 20% tax break to any steel manufacturer employing over 10,000 workers, the whole industry's average costs drop as they scale up to meet that threshold.
Okay, but doesn't getting too big create its own problems? I mean, a factory can't just grow infinitely without the wheels falling off.
If we connect this to the bigger picture, that brings us to diseconomies of scale.
Diseconomies of scale.
Yeah. When a firm grows too large, it becomes overly complex. You get management bloat, communication breakdowns across time zones, and bureaucratic bottlenecks.
Right, too many cooks in the kitchen.
Exactly. At a certain point, the average cost per unit actually stops falling and starts to rise again because the friction of managing the behemoth outweighs the efficiency of the robotic arms.
So bigger isn't always cheaper forever. There's a sweet spot. And speaking of pricing strategies, a blog from Sage Expense Management highlights something called the markup trap.
Oh, this is fascinating.
Standard academic textbooks will tell you that sunk costs and fixed costs shouldn't affect how you price your product. You are supposed to price based purely on your variable costs and what the market demands. But real-world research proves the opposite is true.
Right, the academic theory crashes into operational reality. If a firm gets hit with a sudden fixed cost shock, say their property taxes double, or interest rates on their massive equipment loans, spiked textbook theory says they shouldn't raise prices because their variable cost to make the widget hasn't changed.
But in reality, they are facing strict liquidity constraints. It's survival mode.
Exactly. If they don't raise prices to cover the new fixed cost, they literally run out of cash and go bankrupt.
Wow.
So they increase prices to pull future profits into the current period just to keep the lights on. Which means if you are just relying on an economics textbook, you are missing the psychology of how companies actually behave under pressure.
And that gap between theory and reality sets us up for the most significant and, frankly, the most dangerous revelation in our entire source stack.
Yes, it really does.
The accounting illusion. We are moving into the deep dive from the WIS Financial blog on absorption costing versus variable costing. If a company successfully scaled up, they run into a massive structural accounting quirk that can completely distort their reality.
This is where cost behavior literally shapes human behavior. According to WIS, GAAP and IFRS legally require something called absorption costing for external reporting.
External reporting meaning the financial statements you show to investors, banks, and auditors.
Right. And let's break down why auditors demand this. It's rooted in the matching principle. Auditors don't want a company expensing a massive multi-million-dollar factory operation in month one, showing zero profit, when those factory costs are meant to support products that will be sold over the next 10 years.
That makes sense.
So absorption costing dictates that all of your fixed manufacturing overhead, the factory rent, the salaries of the floor supervisors, the depreciation of the machines, must be assigned to each individual unit produced.
Okay, so those fixed costs are literally absorbed into the physical product.
Yes, and critically, they are stored in the value of the inventory on the balance sheet until the unit is actually sold to a customer.
Wow.
Contrast that with variable costing, which is strictly used for internal management decisions. Under variable costing, fixed overhead is immediately expensed as a period cost. You just write off the rent for the month on the income statement, regardless of how many units you make or sell.
Okay, let's do the math on the absorption trap because it is staggering. Let's say a manufacturing facility has $600,000 in fixed overhead for the year, and their normal capacity is to build 60,000 units.
Okay, tracking.
So $600,000 divided by 60,000 units equals $10. You bake $10 of fixed overhead into every single widget.
This is the crucial mechanism right here.
So in a given quarter, the factory produces 15,000 units, but they only sell 12,000. So they have 3,000 unsold units just sitting in a warehouse. Under absorption costing, those 3,000 units absorb that $10 of fixed overhead each. 3,000 times 10 is $30,000.
Right.
That $30,000 of overhead cost is removed from the income statement and deferred to the balance sheet as inventory.
And because the cost was deferred to the balance sheet, it isn't reducing your profit for the quarter.
Oh my God.
Which means, under absorption costing, your reported profit magically looks $30,000 higher than it would under variable costing. Not because you sold more, not because you were more efficient, but simply because you put unsold boxes in a warehouse.
So wait, what does this all mean? Let me put myself in the shoes of a factory manager for a second. If my year-end bonus is tied to reported profit, couldn't I just force my factory to run 24/7?
You could.
I just overproduce thousands of units that I haven't actually sold to anyone, shove them in a warehouse, and artificially inflate my income by hiding the overhead on the balance sheet?
You absolutely could. It is a massive, real-world perverse incentive. By overproducing, you artificially boost short-term paper profit, ensuring you hit your targets and get your bonus.
That's insane.
But in reality, you are destroying the company's cash flow. You're tying up vital liquidity in unsold inventory that costs money to store and might become entirely obsolete before it ever finds a buyer.
So you're literally bleeding the company dry of cash to make the profit on paper look amazing to the board of directors.
This is exactly why financial controllers must meticulously reconcile external reporting, the absorption costing, with internal reality, the variable costing, to prevent managers from bankrupting the company through inventory hoarding.
Wow. We have covered incredible ground today. From realizing that depreciation is the silent killer leaking out of your car budget to calculating the absolute burn floor that dictates a company's survival.
That's a lot of layers.
It really is. We learned how to mathematically untangle messy mixed bills with the high-low method, how to weaponize economies of scale, and most importantly, how to avoid the dangerous cash-destroying illusions of absorption costing.
It fundamentally shifts your perspective. You stop looking at expenses as just, numbers leaving a bank account and start seeing them as structural levers of strategy.
Yeah. And I promised a final thought for you to mull over, and there is a quote from the Corporate Finance Institute text that perfectly caps this off. It's from management professor Frederick Hertzberg.
Oh, I love this quote.
He warned about becoming too obsessed with driving down these costs, he said. Numbers numb our feelings for what is being counted and lead to adoration of the economies of scale. Passion is in feeling the quality of experience, not in trying to measure it.
It's a profound warning, really. If we spend our entire corporate lives relentlessly driving down our per-unit variable costs, perfectly optimizing our scale, and automating every human element to lower the fixed overhead, at what point do we lose the humanity, the passion, and the actual quality of the very thing we set out to produce?
At what point does the perfect spreadsheet kill the soul of the product? It's definitely something for all of us to think about. Thank you for joining us on this deep dive. I highly encourage you to look at your own life's fixed and variable buckets through this new lens. Check your own assumptions and make sure you know exactly how much water is dripping out of that leaky bucket. Until next time.